thanks very much to everybody for joining us. For those who don't know, my name is Richard Betts. I'm the co-founder of Real Asset Media. We're a publisher, event specialists, but also we do a lot in terms of video content more generally. Insight is the main magazine, the flagship magazine that we publish. And in the next issue of Insight, there'll be a special on logistics, crossing over actually as well into digital infrastructure, where you'll be able to read the content from this event and other events that we're running at the moment on logistics. We also publish Impact, which is around sustainability, social impact initiatives within the built environment, and Real FDI, which is designed to cross over between the foreign direct investment flows as well as the opportunities in cities, regions and countries. For those of you who are at Expo Day, we also publish the Expo Day, which is the English language daily there. So if you've got company news, those kinds of things, now's the time to let us know because there's about a month to go. We're deliberately collaborative with the industry, which is why we like working on these things which are around research, insight, putting information into the market, which helps create more transparency and encourages more investment. With that, I'm going to hand over to Kevin Moffat to give us the research presentation. And then we're going to have a panel discussion. We've got a super panel there. So after the research, there'll be plenty of opportunities for me to ask questions, but also for you to ask questions. But because we're all here in the room, let's give Kev a big round of applause. Kev.
Richard, thank you very much. And I just want to echo the thanks for so many of you making the effort to be here with us in person, given the situation on public transport here in London today. This is our 5th year of doing the European Logistics Census, and actually it's our first year of doing it with Brookfield as our partner. We're delighted to be working with them, and we're delighted that they've been able to offer this facility with fantastic views all across London for us to be able to share the results with you today. I also want to give thanks before we start to our research partner Analytica. Analytica have been instrumental in helping us get over 700 responses to the survey this year. It's actually our highest number of responses ever in the 5 years that we've been doing that. So we're delighted. And I also just want to flag the hard work of Andrew Blennerhassett in my team. Andrew's been doing all of the heavy lifting in terms of the data analysis, trying to pull out the key themes and so on. So I've got around 15 minutes to give you a bit of an insight into some of the key themes that have come out of this year's census. We go to occupiers, investors and developers. We're going to focus the majority of it on the occupier responses to see how the sentiment is in that world. The report is due to be released today. You will be sent a copy of the report, and you will also be sent a copy of the slide deck afterwards as well. So the report is 10 to 12 pages of insight, and I've just picked out what I believe are the key themes. I've split the deck into 3 segments, really. A little bit around the geopolitical situation and the macro piece, then focusing in on the occupier results, and then a little bit on the investor-developer side of things as well. Firstly, a little bit of shameless self-promotion. This QR code takes you to the Savills industrial and logistics space on LinkedIn. If you scan that, you can subscribe and follow us. All of our research, blogs, thought leadership, buildings that we're marketing potentially on your behalf, that's where it all goes. So it's a really good place to find everything you need on industrial and logistics. So to get into it, if any of you were at Shedmasters earlier this year, which is a big event in Lisbon, you'll recognise this slide. I haven't changed it because effectively we started the European Logistics Census 5 years ago, and in that 5 years we've had 5 years of quite astonishing disruption, really. We've had the global pandemic, the market boom that came with it. double-digit rental growth, double-digit capital growth. Then, unfortunately, we've had war, conflict in Europe and the Middle East. We've then seen the cost of living crisis, a surge in inflation, rise in the cost of debt, followed by a slowdown in activity in capital markets and leasing markets. Last year, we had a huge amount of political upheaval, elections all over the world, changes in policy. Yet, nevertheless, we still see continued growth in online retail and the impact on the market that has. We see the impact of nearshoring, reshoring, which I'll talk about in a few slides' time. And then we have the impact of the data center market as well. Yet, really across Europe, both businesses and consumers are being impacted by rising taxes and how that's impacting consumer behavior and business investment decisions. And then we have probably the most consequential piece of cardboard ever displayed in the White House garden on April the 2nd, Liberation Day, and the impact that has come with that around uncertainty, business confidence, consumer confidence, and so on. So, a little bit first, these are forecasts from the IMF about GDP growth. And effectively what you can see there is how these have changed, over the course of the year. The yellow bar is the forecast from January, the blue from April, and the red over the summer. And you can see, the changes that have been brought to those forecasts as a result of, Liberation Day in particular. And the only bit I want to flag really here is how you can see that the euro area is languishing at the bottom of the GDP forecasts for across the world. Nevertheless, despite all of this, consumer confidence remains reasonably healthy. I always say this, people get bored of me saying this, but I'm going to say it again. On the whole, at a European level, 2/3 of occupier demand comes from the retail sector in some way, shape or form, whether it's online retailers, grocery retailers, traditional retailers, logistics companies servicing retail contracts. So the health of the consumer is vitally important to our market. And if you look at the blue line, yes, we've had an impact, a negative impact on consumer confidence as a result of April the 2nd and everything that's followed. But on the whole, people are reasonably happy with the situation of their own household. And that's important. They're a bit more worried about the wider economy, which is the yellow line. But on the whole, when you turn the question back on the consumer themselves, they're feeling okay. So that's a good sign for the market. And again, if we look at some of this data about retail sales and manufacturing output, a few bits I want to highlight there. The German manufacturing data has been increasing for the last 3 or 4 months. That's a good sign. And then retail sales across Europe are increasing as well. So again, some really positive drivers there as we head through 2025. E-commerce, I've already mentioned, the growth of online retail continues. We believe Amazon in the UK have around 10 million square feet of active requirements, and their sales continue to drive. But nevertheless, we've been updating this map for the best part of 5 years now. And, the point I would make about supply chain disruption, COVID brought this into the boardroom, but there are now many other factors keeping supply chain disruption within the boardroom impacting occupier decisions. So I want to get into the meat of today now, the real points from the census and the survey, and try and draw out some themes that Richard will interrogate in our panel discussion. A little recap on 2025 so far. At the start of the year, we were tracking occupier requirement levels up. We were seeing more occupiers active in the market looking for space. A growing defence sector and the impact on European industrial and logistics markets. It's been a very busy 2 weeks for Savills Research. Just last week, we published a paper on the potential impact of increased defence spending across Europe. That's on our website. You can read that for yourself. And there's another webinar you can rewatch as well. But effectively, our conclusions from that report were that if European NATO countries meet their requirements in terms of defence spending, we can expect to see an additional 37 million square metres of demand from those type of occupiers. Now, we don't know at this stage, will that be existing buildings? Will it be speculatively constructed buildings? Will it be leasehold versus freehold? There are lots of unknowns with this, and you can read more about it in our report. But nevertheless, we think it's going to have a big impact on the market moving forward. Sadly, I think is the point to say there. We were seeing vacancy peak in some markets, although that has changed as the year has progressed, and I'll talk about that in a few slides' time. And we're beginning to see land being lost to the data centre community. In the UK alone, where we have the most granular data, in 2024, there was roughly 8 million square feet of land or developable land that was lost to the data centre world. This was land being promoted for industrial and logistics. That has an impact on development pipelines. It will have an impact on vacancy rates, and in turn, it will have an impact on rental growth as well. So that's an interesting point about the data center space and how it impacts our world in logistics. A couple of headlines on the market. So far this year, we've had just shy of 12 million square meters of take-up in the first half of 2025. Now, that is lower than the pre-COVID average. And that's the first time I've been able to say that, actually. And I'll talk about take-up levels in a few slides' time. And then, during the height of the pandemic, the pan-European blended vacancy rate was 3.2%, and we're now at 6.7%. And I said a few slides ago, vacancy was trending downwards. Actually, the last 2 quarters, it's trended upwards, predominantly driven by increased levels of supply in Eastern Europe and CEE markets. So, the first question we always ask our occupier audience is, how are you viewing your business conditions when compared with last year? Now, this is super interesting because the survey ran over the summer, so post-Liberation Day. Now, if I was a glass half full person, I'd be saying, well, look, this is really interesting. 40% of our occupier audience said business conditions are in the more favourable side of things. So that's a good sign. If I was a glass half empty person, I'd be saying, well, actually, if we compare 24 in the yellow with 25 in the blue, you can see that there's been a slight increase in occupiers saying things are more difficult. So a mixed picture in terms of that overall business confidence. Now, this looks like a complicated set of charts. Let me just explain what's going on here. The pie chart. What that is effectively saying is that 21% of our occupiers are proceeding with their expansion plans as they are. However, almost 2/3 of our occupier audience has said, actually, we're just pausing things. We're on hold by a year, 12 months, 18 months, whatever it may be. So that is an interesting development. And if you look at the graph on the right, effectively what that is saying is expansion plans are skewed more within the 1 to 3 year time horizon rather than the 12-month horizon. So that feeds through into the sentiment from our occupational brokers, space taking longer to lease, occupiers being slightly more hesitant, deals taking longer to get over the line. And here we are again. I said, take-up has been impacted by the uncertainty. Q2 was weaker than we would have expected. So that means that take-up for the first half of 2025 is 6% lower than that pre-pandemic average. So that's, again, an interesting development. Now, for me, all eyes will be on the Q3 numbers. We're not going to get those until probably early November. By then, we'll be able to see the impact, post-summer holidays, how take-up is, how occupiers are feeling now that, Trump has signed a deal with the EU, the UK, so on and so forth. Now, one of the questions we ask our occupier audience is, where do you expect to take more space? Now, this is super interesting. This year, we have broken this out into occupiers who are based in the country versus new entrants in the country. So there's a whole set of commentary around this in the report. But what is really interesting in terms of this is that we are seeing Western European markets, bigger, mature markets, being the markets that occupiers expect to take more space into. Germany, France, Spain, Netherlands, Italy. Two outliers that I want to highlight are the Czech Republic and Portugal, smaller markets in terms of total inventory, but both benefiting from the nearshoring phenomenon that we're seeing, and we'll talk about that in the panel. So that's a really interesting point in terms of nearshoring and where occupiers are looking to take space and why. Now, we ask the occupier audience, what are the biggest challenges facing your logistics property operations? And we've compared the results, 24 versus 25, 25 being in the yellow. Now, all of the usual suspects are in there, in terms of occupier challenges, lack of supply of new buildings, the permitting process, access to labour. But nothing has changed versus 24 versus 25, with occupiers saying that cost pressures are the most important thing on their radar at the moment. And if anything, actually, that has amplified from 24 to 25. So cost is king here in terms of the pressures in supply chains. And again, we'll explore some of that in the panel. I've already made that point about vacancy rates. Vacancy rates have gone up to close to 6.7%, driven by the Eastern European markets. A lot to take in on this chart. The point I make here is that, okay, even though the vacancy rate is 6.7% at a European level, there is a huge range in our sub-markets. You can see there, Spanish markets, hovering around 12 to 14%, but then you still have a whole host of markets, sub 4 and close to 2. So my point here, if you're making investment decisions, is to really get under the skin of that vacancy data, because ultimately that's going to have a big impact on rental growth. What does this mean for rents? Well, rents are still growing, and I think that's a key point to make. But definitely we're seeing, a slowing of that rental growth, as the chart on the left shows, the line graph. You can see this is our rental index, and you can see that is plateauing, 1.7% year on year. The scatter graph is showing the relationship between vacancy and rental growth. And that arc that goes across the top, those yellow dots, are the last 18 months, where there was a real kind of decoupling of the relationship between vacancy and rents. The green dot is the most recent quarter, and you can see there that we're almost now back on trend in terms of expected rental growth, given the level of vacancy in the market. Now, if take-up continues reasonably strong, which it is on the whole, if the development pipeline continues to decrease, which it is on the whole, then what that suggests to me is that over the next 2 to 3 years, we'll start to see that green dot dance back up the trend line above where we would expect it to be. Occupiers looking at grade A, looking at prime, that flight to quality, bifurcation that we've heard so much about over the last 12 to 18 months. Okay, we ask our occupiers now, where do you expect to invest in terms of technology over the next 2 years, and which warehouse features are most important to you? Couple of interesting trends here. We always keep drone delivery in. Every year we expect to take it out. Nobody says yes. We're going to keep it in for the foreseeable future, just in case anybody ever says yes. This is really important to us. But at the bottom again for the 5th year in a row. For the last 4 years, EVs and warehouse automation have been at the top. This year, something interesting has happened with AI. So AI, optimization analysis, predictive analytics have risen to the top in terms of what occupiers are looking to invest in. Which warehouse features are important to you? Again, some really interesting developments. But the one thing I want to flag here that's come out for the first year is building height being right at the very top. Now, that's an interesting development. Is that automation? Is that utilizing the cube? Is that, space optimization? Something we can again talk about in the panel. Who's taking the space? Well, again, in the UK, where we've got the most granular data, two observations that I want to flag here. Again, a lot of colors in this chart, but what we're looking at here is the sky blue across the top and the yellow across the bottom. The blue is 3PLs. So 3PLs are still around 25% of the market. And that hasn't really changed. If we look at the yellow, that is manufacturing related. So nearshoring, reshoring, friendshoring, bestshoring, whatever terminology we're using, we can see that yellow bar increasing as a proportion of the total take-up. So again, that's a really interesting development if we just look at which occupiers are active and what they might need. Then we ask our occupiers what's on the agenda that could be game-changing for logistics real estate. Again, when we did this initially, we were looking at power, EVs, lower carbon vehicles, automation, that sort of thing, nearshoring, reshoring. Now, for the second year in a row, more stringent ESG targets have come out on top. So when we first started doing this 5 years ago, the ESG point from the occupiers was always near the bottom. For 2 years in a row now, it's been near the top. So I think that's, again, a really interesting trend. Nearshoring, reshoring, interesting. Last year, it fell down the rankings. This year, it's come back up. But if we analyse the occupier profile for the companies who said they are engaged in nearshoring and reshoring, they are disproportionately larger companies. They control much more real estate. So whilst it's lower down the ranking, actually, we think it's going to have still a big impact on the market over the next decade. So that's a point to note there. Okay, couple of slides now on the investor-developer side of things. How much do you plan to develop speculatively over the next year? Again, a mixed bag. A third saying more, a third saying less, and a third saying similar. If we look at the actual speculative development announcements, there is a downward trend in that scenario. However, we asked our developers, what size units do you want to build? And we asked our occupiers, what size units do you want to occupy? And it would seem to me there is a bit of a mismatch there in terms of what the occupiers are saying at the smaller end versus what people want to build at the bigger end. So a point of conversation, I'm sure, for our panel. Again, we asked our investors, what are the biggest factors impacting the investment market at the moment? Last year, it was the availability of price and debt as the most important. So we're looking here at the yellow and the blue. Last year, it was the price of debt and the availability of debt. This year, it's the occupier market conditions that have risen to the top in terms of how investors are thinking about the market. Another interesting slide. 5 years ago, when we started this, we asked our investors, where would you like to invest? And if we then mirror that with where the occupiers want to go, 5 years ago, there was a mismatch. Investors looking at different markets compared to where occupiers wanted to go. This year and last year, actually, it's almost a mirror image of where the investors want to go and where the occupiers want to go. So that's a good point, in terms of alignment, in terms of capital and activity. And again, logistics and industrial is still, flavour of the month, along with the residential sector. I've just highlighted the numbers there in the kind of bluish line at the top. Pre-COVID, industrial was around 15% of total investment. Now it's around 22%. Slight drop in the total But really, that's been at the expense of the office sector, which you can see pre-COVID was around 45% of the market and is now 21% of the market. Investment volumes, a slower start after a really, really strong Q4. Momentum building. But as we've headed into 25, there has been a whole myriad of reasons. And that means investment volumes reached 18 billion in the first half of 2025, 18 billion euros. But you can see, about 9 billion a quarter. With a fair wind, we'll see something similar happen in Q4 this year. And again, I'm sure the panel will have their views on where that's heading. Last slide from me. Prime yields. Our blended pan-European average is 5.23% at the moment. 64% of our investor survey expect between 4.5% and 5% by the end of 2026. I know that's a question for the panel. Where's pricing heading? Couple of conclusions. Occupier sentiment, better than expected, hasn't translated into take-up levels in the first half. ESG, really important and growing. Developers, mixed bag, but the strongest response was more. Investors, more optimistic and looking forwards, whereas occupiers potentially looking backwards and trying to catch up. So that's me. I will now hand over to our panel. Thank you very much.
Let's just start with quick introductions, and maybe we'll start with you, Ben, and work our way down. So just quick introduction of who you are and what you do.
Morning, I'm Ben Segelman. I am Head of Logistics and Data Centers at Brookfield Asset Management.
Great. Sander.
Yeah, Sander Breugelmans, Head of Capital Deployment for Prologis.
Morning, Saul Resnick, DHL Supply Chain CEO for UK and Ireland.
So I'm Pedro from Savills, Portugal, and been covering industrial and logistics over the last 5 years on our market.
Great. So you can see we've got a range of different views here from both the investor side as well as the occupier side. And also it allows us to drill down into one of those countries that Kev mentioned, which was Portugal, in terms of taking a deeper dive into a market. Ben, let's just first of all start out with you, and thanks again from me and everybody for hosting here. What a fantastic space. Maybe just some of your reflections on some of the research. What surprised you there? What made you think out of the presentation that we've just had?
I think for me, it's the divergence of where investor sentiment and occupier sentiment currently sits. You kind of hope that they align and are pointing in the right direction. But I think what we're seeing is investors and developers looking further forward and expecting, occupiers to catch up. Obviously, I think one of the things we saw is that there is some optimism with occupiers, expecting that things will improve. But if you look at the statistics, the occupiers just aren't really there yet. There is a growing vacancy that has come through. But look, I think we're optimistic about 2026, and hopefully we will see that convergence happening at that time.
Okay, good. Maybe, Sander, just for you, let's pick up a little bit on that ESG point, and feel free to pick up on anything that you've seen that surprises you as well, or that confirms things that you're seeing in the market. But let's pick up a little bit on that ESG side. How do you see that playing out? Do you see that becoming, Kev mentioned there that it's come up for the last 2 years in the survey, and interestingly was much higher up at the moment. Are you seeing more of a realism about that? What's your sense of it?
Maybe first quickly back on the report itself. One thing I did notice, I'm a bit optimistic actually also reading it, it's kind of the resiliency of the sector. You see that from occupiers and investors, right? Yes, it's one of the most difficult macroeconomic backdrops we've seen in years, but occupiers are still taking space. They're still looking for modernization, supply chain optimization, etc. And also on the capital market side, yes, investors are cautious, but it's still more than a fifth of the real estate capital deployment goes towards logistics. So I see that as a positive. Coming to ESG, it's still one of the major requirements from our customers, but I do see that it's really focused on operating costs as well. So the best ESG for our customers is what keeps their, in the end, their electricity bill low, and at the same time allows them to automate their warehouses. So it's all about on-site power. It's about rooftop solar. It's about long-term PPAs. It's about battery storage to make sure they keep their operating cost in check, and they can automate their warehouse over time. So if you apply ESG that way, it can be a competitive differentiator.
Okay, good. Saul, it'd be interesting to pick up from you. And again, anybody pick up on any of these points, don't necessarily wait for me. Interesting for you, just any reflections on the presentation, especially, things that picked up for you. But also, I thought the cost element was quite interesting in that. So it'd be interesting to pick up, I suppose, on some of the challenges that you're seeing in your business and how that relates to what we've seen in the research, perhaps.
Yeah, thanks. And just echoing a little bit of what Sander was just talking about, from a carbon neutrality point of view, I'd say from a DHL perspective, that's almost a hygiene factor now. It's a base assumption. Without it, it's a non-starter, specifically on new builds, and even the cost of modifying from brownfields as well. But then you've got this dichotomy where you've got a much higher reliance and expectation on automation as well. So we're doing, you saw what the height of buildings as well, which came up, and that is real. So one of the developments that we've just taken on in the Corby area, looking to go 40 meters high, because that's an expectation that we have, so that we can use more automation, more high-density storage, which requires more power. So you're in this circle where you need access to power, which is another challenge that we have in the industry as well. So it's not just about having power, it's where the power is. And then the ability to meet our expectations, but also be carbon neutral and manage costs. So it's a pretty challenging dynamic. The one thing that probably stuck out most to me in the presentation Kevin did is that he uses a lot of colors in his presentations. And I thought the blue was black, but that's another issue altogether. But what really stuck out for me was consumer confidence. I probably have a slightly more pessimistic view in some ways. I think that the economy is struggling. I think we've seen it, a lot of high street liquidations, clients of ours in the last 12, 18 months. That's a challenge. And companies that are struggling right now from a financial cash flow perspective. And that concerns me. Yes, you have those companies performing well, but a number of industry not performing well. And not meaning to be controversial, but a lot of the government involvement at the moment hasn't been particularly helpful from a cost imposition point of view. So increased taxes from a national insurance, minimum wage, and soon to be land tax are real headwinds into the business that we just don't need right now. And that, to me, will have an impact. We've seen that from an inflationary point of view, but will also continue to have an impact on consumer confidence, and as a result of that, our ability to meet customer expectations.
Okay, that's interesting. That's specifically a UK
specific to the UK
position.
Correct.
Might be interesting to pick up, because it was interesting, that point, because e-commerce continues to rise, but interesting that retail confidence continues to grow. Is that something that you're seeing? There are specifics, I think, in the UK market. I think you're right, Saul, on that. How are we seeing that in Europe? Because Kev mentioned that growth in terms of retail. What are people seeing on the ground in their areas?
I think it's a really interesting one, and for a while, we saw that tail off with the large US e-commerce groups, the well-known ones, certainly sort of reducing the amount of take-up. But that is coming back. I think it's well recorded now that they are back in most markets. But the other interesting one that we've seen here at Brookfield is the growth in the number of Asian and particularly Chinese retailers who are looking to gain access into the European markets at the moment. We had one such example where the group came in, saw our building, and within a month they were in occupation, having signed at a record rent and taking the space within a record time as well. I mean, it really is about operational readiness for these types of groups who obviously want to front-load their access into the European markets, which obviously is a change, probably a move away from the US.
Okay, interesting. Sander, good to pick up your view on that.
Yes, we definitely see the demand from the retail side, both online and offline. So the likes of Amazon, they of course had a big post-COVID headache, taking up too much space. We're very quiet in the market. but they're definitely back now. And so the demand from e-commerce is certainly there. But then also traditional retail, right? And also a lot of retail that is food related. There we see quite some strong requirements. But I do still feel that the demand is diverse, though. We also see demand for pharmaceuticals, healthcare. We still see actually really good demand for spare parts, automotive. So it is pretty diverse and robust.
Okay, good. Pedro, just to pick up with you, Kev mentioned obviously Portugal, but it'd be good to get your insights on how the logistics sector is developing there. What are some of the drivers? Are you seeing the same concerns that are shown in the survey here, or are there specific ones to that market given the amount of growth there is at the moment?
Yeah, sure. There are a lot of things that are quite common. So logistics activity is the core related to retail. E-commerce is yet to, and I will have the help of Kev's team work like 5 years ago on the tipping point for e-commerce boom. We're getting to that point where then occupiers, their needs for logistics space really increase. But I think what we are seeing as a change is industrial activity. We are seeing more and more interest on industrial activity, picking up some of it already happening. And these typically are 2-3 year projects that we are really eager to see what will happen over the next 2 years if they stay, if they come, and we have a beautiful tailwind on that.
Okay, good. And we'll drill down a little bit more into that. I'd be interested to pick up a bit, Kev, on what you mentioned, which was the defence element, and obviously the announcement across Europe of increased spending on that. And I don't know how much you can say about this, Saul, I guess, but I think there was a memorandum of understanding here in the UK, because it would be interesting to sort of get an idea of what types of things people are looking for and how much the private sector, for example, DHL, but also the real estate side are going to be, part of that.
Yeah, as we speak, there's a convention happening not far from here with a number of, which I was at yesterday, a number of stakeholders displaying their wares, which is quite an interesting show to walk through. There's a lot happening. I think all I will say, we have signed an MOU to collaborate with the government along with other companies in the industry in terms of employment of individuals and readiness for operations should that occur. I think there's a growing level or sense that there will be military activity for the UK at some point in the near future, and an expectation that will occur, and then that obviously necessitates that there will have to be more investment in military infrastructure, in armaments, etc. So, it's a big business, military spend, and I suspect that'll have a spin-off to a number of players, specifically in this room, but in other areas as well. How that manifests in terms of what size space, I don't know the answer to that. What I do know is that it will be more than what it was 5 years ago. In 5 years' time, that's a given. But how that plays out, it will be hard to tell. But aspirationally, for governments to spend what's an expectation from a NATO spend percentage is a significant increase in what they're currently spending. How they afford that's another question altogether. But that's something for a different discussion.
Right. So we had quite a funny little anecdote on that. We had it will remain a nation I won't say the name of, but a North European nation, small army, but wanted to engage on a property that we have to lease or to sell, and they said they'll take it. And we're like, fantastic. Let's talk numbers and terms. And turns out they were talking about the annual rent to try and buy this property. So I think there's an element of reintegration into these markets and a learning curve that these militaries will have to take to actually start to be real players in that as well.
Okay, good. Any views on that, Sandra, is useful, but
maybe just because it's too early for us to really see exactly what that demand is going to look like and what type of space it needs. But I think what's important to point out is that these large investments that governments will have to do, will be a boost to the economy, right? And especially thinking Germany, which has been really hit hard by tariffs on automotive, but also already with the gas, with the energy transition, getting off gas, the immense investment right now in infrastructure and defense, will help that economy and will, in the end, also lead to customer demand and demand for our space.
I wanted to pick up a little bit actually on customer demand. You mentioned it a little bit, Saul, but Sander, in terms of recently in your earnings call, you were talking about development, build to suit coming back in, mainly in the US, I think. But are we going to see that in Europe? Because obviously there's been a lack of development for a period. Do you see that coming back in? And I suppose, what are the occupiers looking for? What are you planning for in terms of that development? And then I can also double check that with Saul to see whether that's what he actually needs.
So yeah, we're absolutely seeing that in Europe. Also, part of that is kind of forced, right? We're very careful in starting any speculative developments. You don't want to be developing into a market where vacancy is still rising. So we've been laser focused on capturing that build-to-suit demand that is in the market. And those are not easy. It's not easy to capture the demand. Decision-making is very slow. So to get a customer across the finish line will easily take you a year or 2 years. But this year, so far, about 80% of our development starts have been build-to-suits. And if I kind of look towards the rest of the year, I expect that to remain as well, with probably the strongest build-to-suit pipeline that we've had since COVID. And even during what is normally pretty quiet months, July, August, just last month we signed a big build-to-suit here in the UK for Marks and Spencer's, 1.3 million square feet. And for them, that's an investment of probably about £340 million. And that's even before they start doing their full automation. So we do see customers, and in this case, a retailer, making some significant decisions. It's just taking longer for those decisions to happen. But at some point also, when it comes to supply chain optimizations, they're not decisions that can be pushed out forever. At some point, they will have to happen, and they're happening now.
Okay, good. And Saul, it'd be interesting to know from your point of view. I mean, there was originally, Kev mentioned there was a lack of supply of buildings. Now vacancy seems to be increasing. What's your sense of that, and what are you looking for in the buildings that you're aiming for in the future, or for now, or transformation? What do you need?
Yes, it's a bit of a mixed bag, because I agree there is a demand for build-to-suit still. In certain industries or sectors where there's a higher demand, so healthcare as an example for us, we've invested significantly in healthcare. So we are playing in that space, and that has obviously a lot higher barrier to entry in terms of cost to build and the various requirements from a compliance perspective. Manufacturing, there's been less manufacturing onshore over a while, so those companies are perhaps down volume-wise. So we've got a bit of a mixed bag in terms of vacancy in some areas and over demand in others. The challenge, I think, in the 3PL space specifically, in a very cost-competitive environment, is specifically in the UK, that is, you've seen a race down to the bottom in some scenarios for a margin perspective, and therefore the appetite to take vacancy on in buildings is obviously going to be reduced significantly. So build to suit but backed by significant contracts is still going to be the requirement, and I don't see that change anymore. The appetite to hold vacancy in the case something happens is probably less, so there's a bit of circumspection in that regard. But I think what we're doing is we're doubling down on industries where we see strong demand, whether that's battery, automotive. Ben spoke about Chinese manufacturers coming. We're doing a lot in that space as well, and a lot in healthcare. But then other sectors probably aren't as buoyant as those.
Okay, good. And Pedro, maybe from your side, how are you seeing demand at the moment, vacancy, those kinds of elements within your market?
So we came from our record year in take-up since ever last year, okay? And this is one of the things which was a bit different in our market. These have been incredible 5 years. Take-up this year, we don't expect to reach the levels of last year. It's completely subdued by stock. We have a 3.5% vacancy, okay? of which 2/3 are C graded or less, and that's the story behind our market. So you didn't develop for almost 15 years. You are now starting to doing everything, and that put immense pressure on rental growth. So you had like 40% rental growth prime area within 4 years. So the outlook now, you have tenants needing that demand. The demand that Savills team tracks is 20% of the total stock of the market. Okay, and this is just Savills team. So pressure is there. Decision is taking more time, as we were seeing here with the panel. It's true, especially big occupations, built-to-suit occupations. In fact, we totally relate to that 1 year to 2 years up to the contract. But the fact is that they represent every year usually about a third of total take-up. Okay, so and that's the opportunity within our market, and that's what we see on the backstage, changing gradually, and more capital coming towards this. Probably we will see the biggest speculative development pipeline up until the end of the year that the market has ever saw since we have records.
And there's a question from the online audience, which is about bifurcation in the market, and I'll pick up on that with everybody. But is what Kevin was saying in the research also true in your market, that you've still got to look at very specifically the locations, which cities, which part of the cities? So although there is this big growth, is it still something where you've got to look specifically at the locations in terms of the bifurcation in the market?
Absolutely, and clearly occupiers and also investors are taking a new approach. Cities have grown towards the previous logistic areas, so you're now seeing the emergence of new prime areas, especially on the big box side of things, and it's also where you can build with size and scale, which is cost efficient, and where demand is looking for the big and mega box, which usually in our market, it's a consolidation movement. They're leaving 3-4 sites with 30 years plus, okay, to consolidate in the search of efficiency on 150, 60, 100,000 square meters box.
Okay, great. And it'd be interesting to pick up, Saul, from your viewpoint in the UK. Is there a bifurcation here? Where are you looking? Where are you not looking?
A big factor for us is source of labour. So, our centre of gravity is in the UK, specifically the Midlands area, but it needs to be close to where we can access pools of labour. Unemployment numbers have helped us in some regards in that way, most recently, because we've seen an increase in unemployment numbers, which is not great for the economy, but we are seeing perhaps more labour availability, and we've seen lower levels of attrition in the last 3-4 years, certainly since COVID. So that helps in that regard. But from our perspective, it's cost and ability to go high. Those are probably the 3 dimensions in source of labour, height of the building. Actually, there's a fourth, and that's power. So probably the fourth aspect as well.
Okay, good. It'd be interesting just to get the pan-European sense as well of the bifurcation element. And on that, there's a couple of questions coming online as well, really about the vacancy that Kev was talking about, which picks up this point. Given the different vacancies across the regions, will we see higher, lower vacancies going forward? But also a mention of Eastern European and Central and Eastern European markets, and a question about whether that's led by more speculative development or second-hand returning or both. So I guess interested to pick up your views on either of those points, really.
Shall I go first? So when it comes to the bifurcation in the market, it's definitely there in terms of location, but also very much in terms of asset quality, right? And I think Kevin touched on that. Because when you really start digging into the vacancy numbers and you go a bit more granular, then there is a big difference in vacancy between Class A space or Class B and C space, especially in markets like Madrid, for example, Milan, but also actually in the UK. So that builds to demand that we see. It's often also consolidation and modernization and replacing some older facilities that customers are leaving behind because they just don't work anymore. So that's definitely there.
I mean, you mentioned that Central Europe is obviously an area where vacancy has risen, and there has been, and historically has been, an oversupply within those markets. But at the same point of time, those markets are relatively cheap for occupiers. There is a good pool of labour. But I think, those occupiers are going towards the most institutional, newest, greenest, best located assets. I mean, look, Poland, Czech Republic are still markets that we look at, but per the census, our focus will remain on the stronger, more core locations of the UK, Germany, France, Netherlands, Italy, etc.
Okay, good. And Pedro, it'd be interesting to pick up from you. I mean, Kevin, in the survey there mentioned key Western European markets, but the Eastern and Southern European markets are most likely to benefit from things like nearshoring. What's your sense of that in terms of the Portuguese market? Do you think there's a mismatch between the capital and actually that nearshoring trend? What's the situation?
So, starting from the demand and that nearshoring movement, we've seen it over the last year. We've been able to assist for instance, to Chinese industrial manufacturing companies setting up their first facilities out of China to serve both European market, and in one case to serve both European and US markets. Okay, because given the pivotal position that Portugal has, and a couple of weeks they can be on the East Coast. We see more and more companies flying in, looking at that. But what we started to see, I would say, mostly the last year, and we are monitoring that close, is European companies, Central Europe mostly, looking to move their operations and searching for options. And given the shoring trend, the sort of intra-shoring within the economic bloc of Europe, which relates to one basic thing, which is a key input, which is energy prices. And what changes after 2022, 23 is that within, and especially in Iberia, Portugal and Spain, where you have more than 80% of your energy mix are renewables, these countries have the cheapest energy costs in Europe, so there's always competing on the lowest ones. And this is a key input in industry, that Central Europe had this over the last decades, and you see this intention to move. I already saw a couple of things going to Spain, for instance. I'm wondering, given the massive number that Kevin gave us, 37 million square meters for entire Europe for defense industry, this is a much more value-added industry and needs to be in certain geographies, in certain locations. And I'm wondering if there won't be more industry within Europe relocating to where energy is cheap and those goods can be produced there, so we can focus resources on those other regions for the defense. And another final part, yeah, there was a mismatch. As I told a couple of minutes ago, you'll start to see that development capital coming in that will allow, because when you see on these cases is that where do I have land, where do I have a facility to have a 50,000 square meter industrial facility to start as soon as possible. And if you don't have those potential sites ready to be developed, you're losing 2 or 3 years of sales. So this is key. We are now seeing that capital flowing in, and that mismatch narrowing, thankfully, and lead us to let's say, positive outlook.
Okay, good. There's 5 minutes left, so I've got a couple of questions here that I'm going to squeeze in as well in that 5 minutes, because I know, Saul, you have to go on the dot. If anybody's got a question, it's going to take me 3 seconds to scan the room from left to right. So left, you need to be really quick. You've got about an extra second on the right. So I'm just going to scan across, and if anybody's got a question, now is the time to ask it. If not, fantastic. It's all me, which is great. Let's just pick up on supply barriers, I guess, Sander, in terms of the development side. So I suppose constraints? How's that shaping it? What's the situation in terms of your development strategy around those barriers, really?
Yeah, so the land available for logistics is getting more and more scarce, right? Greenfield land, getting that rezoned to logistics is politically getting tougher and tougher. So you're talking mostly brownfield redevelopments where you already have industrial zoning in place, where it's easier to get your entitlements. But with that, they are very lengthy processes. So you really need to have boots on the ground to navigate the local political landscape. You need to deal with demolition, remediation. They're complex and expensive projects to really get to the point where you can go vertical. So it's having the teams and the expertise in place to unlock that. And then on top of that, I think what Saul said was very interesting around power, right? Because real estate has all been about location, location, location. I think power is now really an important element of that as well. Everybody talks about the power needs for data centers, but I think we're underestimating the future power needs for logistics. I mean, it's already tough to get your workforce in place. European populations are aging. There's more and more pushback on immigration. So I think labor is going to be a huge issue going forward. And in order for the logistics facilities to be automated, they need to have the right power supply in place. And you can already see that in many countries, Germany, Netherlands, the grid capacity is becoming a real problem. So having a solution for that, we actually starting already to develop our first off-grid developments. So working with a combination of rooftop solar, battery storage, backup generators, to still be able to unlock land and develop, because I think power is going to be almost as big a constraint as just the land itself.
Maybe we can just ask a question, perhaps for Sand or Ben, is that, and Gareth from our team will be very upset if I don't ask, is that why in the UK, or why in Europe from an investor point of view, you're happy to take 9-year investment from a yield management perspective, but in the UK it needs to be more like 15 to 20, which is something that hampers our ability to develop.
Yeah, I think it's very strange, actually. This actually doesn't really help me, but I've always been surprised by how long lease terms are in the UK. I mean, in the continent, we've done build-to-suits with 5-10-year lease terms. And I think as long as we can develop an asset that is generic and it's releasable again, I don't see why not.
Great.
Will be
We'll
higher
talk
rents,
later.
but
Quick question that came in from here, and I don't know whether anybody can quantify this, but similar to height requirements, are there minimum power capacity requirements that occupiers are looking for, and can it be quantified? I guess the answer is lots, Saul, is it? I don't know.
I don't think you can have enough. I think, there's the aspect of what warehousing requires and what Sander's referring to from an automation perspective, but, the intention from a government point of view on vehicle change and HGV requirements going forward and getting rid of diesel vehicles means that, I think the exercise we did for our transport fleet, we presented to government recently, would equate to about 60%, and that's just our needs, of the largest nuclear plant in the country in 10 years' time or 15 years' time. So you extrapolate that in terms of what is required on site. First, I don't think that's possible, but secondly, if you extrapolate that on site, what's required from a battery electric charging point of view, it's as much as you can provide.
Okay, great. Last question, 30 seconds each, is, I guess, either what is the biggest change that we expect to see in the year ahead, or where's the biggest opportunity, do we think, for the sector? Let's start with you, Pedro. Unfair, I know, but you've come the furthest, so what can you expect?
No worries. So I don't expect a specific change, but the consolidation of the trends, because there are shifts, and what we covered here as specs requirements from occupiers being more demanding, the topic on ceiling height, how prepared assets are for the future. This will be key, and we will be seeing that more crystallize. And of course, that brings us to the opportunity, which is how capital can answer that, because that's a shift, a change in demand that we will see it clearly.
Okay, great. Saul.
Yeah, from a challenge point of view, I don't expect interest rates to come down anytime soon, and I think that's going to have an impact on a range of activities. But from an opportunity point of view, specifically from a 3PL, I see continued growth in that space. First-time outsourcing, companies looking to create flexibility and scalability to their operations based on changing demands. Makes more sense to go to a 3PL type model as opposed to owner-user.
Great, Sandra.
Yeah, I think both the challenge and the opportunity is actually that I think customers are going to require more and more that any development, any facility is both move-in ready and future-proof. So I think you have to start thinking beyond 4 walls and a roof, offering also mezzanine floors, racking, forklifts, EV charging, etc., so the customer can be in operation quickly. And with that also have a facility that they can operate for the long term.
Great, Ben.
I think kind of aligned, not really an opportunity or a threat, but more of a theme. I think 2026 will all be about resilience. We've heard about resilient supply chains and the need for taller, higher facilities, the need for resilient power supplies as well for all the different uses, logistics, data centers, others, cold storage, etc. And I think actually, that's kind of the theme for investors, developers as well, to think about that resilience and how we can help our customers, expand at a time when they need, and in a way, in a manner that also works economically for us.
Great, really interesting. Thanks very much, Kev, for the presentation, and the research teams at both Brookfield, Savills, and Analytica for the research. It's something that I always look forward to at this time of year because it gives you a real sense of where we're heading, and great to get your views on the panel as well. So thank you very much to everybody for joining us here. If you're here in the room, everybody will be here. You can enjoy coffee and a discussion afterwards between yourselves and the speakers. Online, thank you very much for joining us. The slides will be available for everybody afterwards, so I'll make sure you get a link with those on afterwards. And all that's left to say is thank you very much to everybody for joining us. Thank you for Brookfield for hosting, and thank you for joining us online. Thanks very much, everybody.